Question number 2D. Based on the credit rating of the bonds, Mr. Z has decided to apply the following discounting rates for valuation of the bond. Credit rating AAA, AA and A. Discounting rate is given 364 treasurable return, 3% spread, AAA plus 2% spread, AAA plus 3% spread. He is considering to invest in AA rated rupees 1000 face value bond, currently selling at rupees 1025.86. The bond has 3 years to maturity and coupon rate on the bond is 15% per annum, payable annually. The next interest payment is due 1 year from today, and the bond is redeemable at par value, that is at face value. Assume 364 days treasurable rate to be 9%. You are required to calculate intrinsic value of the bond for Mr. Z. Then second and third part of the question is provided to us. Everybody is requested to go through the question and tell me that what is the first question about. The first question states that you are required to make the computation of intrinsic value of the bond. What does it mean, friends? It means that you are required to compute from an investor point of view that what is the maximum price that investor is ready to pay for the security. Over here we have to understand answer like this. Answer of the first question, in that we have to understand answer of question number 2D. We are required to make the computation of the maximum price that investor is ready to pay to buy the security. Intrinsic value of bond. We understand that the bond in a simple language means the debenture. Nothing is different as such for our calculation. Please write an answer. Over here, we are required to calculate maximum price that investor is ready to pay to purchase security. Full stop. It will be calculated as present value of cash inflow full stop. We will find present value of future interest income and present value of redemption value of security. Full stop. It will be considered as intrinsic value of bond. Full stop. Now friends, over here we can very well understand that the investor is going to receive interest of rupees 1000 into 15%, 150 rupees from year 1 to year 3. At the end of the third year, he will receive the redemption value of the security, and the redemption of the security is at par value. That is what obviously we understand. Now it will be discounted. I want anybody of you to tell me what is the rate at which this cash flows will be discounted in present value term. So friends, over here very well information is provided to us with respect to the discounting rate. What sort of information is given? Let us understand. We have been provided with the information that assume 364 days treasurable return is 9%. Treasury bill means the security which is issued by central government, and the security which is issued by central government does not have any risk. And so the central government is giving the return at the rate of 9% to the investor. Listen to me carefully what I am going to speak now. The investor has made an analysis, and as per the investor's point of view, AAA rated security has a required rate of return of 9 plus 3. 3% spread means the 3% additional return required over the risk-free rate of return. So it has been given to us indirectly that 12% is the required rate of return from AAA rated security. From AA rated security, the required rate of return is the required rate of return of AAA plus 2%. So we understand that over here, so it is 12 plus 2. That comes to 14%. That is the way we have the required rate of return. If at all it has only a credit rating, we understand friends that higher the credit rating is indicating the risk element is low. Lower the credit rating is indicating the risk element is more. If at all the risk element is more, then in that case the investor's required rate of return will also be more. So the AAA plus 3%, the AAA required rate of return is 12% plus 3, that is 15%. That is the way we have been provided with the information about the investor's required rate of return for the different securities based on the AAA rated or AA rated or single A rated securities. We have been provided with the information that this security is AA rated security. Like that information is given. If it is AA rated security, then everybody answered very correctly. The required rate of return is 14%. This is what we understand. Dear students, we understand that the credit rating is assigned to a security taking into account that what is the net worth of the company, how is the past of the company in making payment of the financial charges, what is the past of the company for making payment of the redemption value of the security. So taking into account these quantifiable factors, we come to a point that what is the credit rating. There are specific credit rating agencies, like you might have heard about CRISIL. It is in the business of assigning only credit rating to the different instruments. This is the way the credit rating is assigned, and the required rate of return is required to be decided 14%. We will discount the cash flow series at the rate of 14%. to make the computation of the intrinsic value of the security. Please write down the answer. Working note number 1, calculation of required rate of return from security. In the write down, credit rating and then required rate of return. Triple A, double A and A. For triple A it is 9 plus 3, that is 12. 12 plus 2, that is 14. 12 plus 3, that is 15. In the write down further, based on credit rating, investor will have an expectation of return from security. Full stop. Lower credit rating means more risk and vice versa. Full stop. Return from treasury bill means return from central government. Full stop. It is considered as a risk-free rate of return. Full stop. Heading right down, calculation of intrinsic value of bond. Full stop. Try to do answer on your own, then I will do working for you. So let us see that how to make the calculation of answer. First year, second year and third year, every year you will receive the interest income. So it is 1000 into 14%. So the interest income is 140 in the first year, 140 in the second year and 140 in the third year. Redemption value of the security is 1000. Net cash flow. End of year 1, 140. end of year 2 again 140, end of third year double 140. Sorry, 150 rupees is the interest. One fifty, 150 and 150. So 1000 into 15 percentage. So the first year net cash flow is 150, second year it is 150, last year it is double 150. Investors required rate of return is 14 percentage. So we'll compute the discounting factor at the rate of 14%. 1 divided by 1.14, so it is 0.8772. Second year it is 7695. Third year it is 0.6750. It will be converted in present value term, 150 into 0.8772. So it comes to 131.58. Then 150 into 0.7695. That comes to 115.43. 1150 into 0.675, 776.25. We'll make the total of them 131.58 plus 115.43 plus 776.25. So it is 1023.4, that is 26. So the P0 is equal to 1023.26. That is the way we can calculate the answer. Please write an answer. So friends, we understand over here importantly that the question is providing the information about the price of the security. You can see that the question says that the bond is currently selling at 1025.86. So the current price is given to us in the question. Even though we are required to find the intrinsic value, it means we are required to find that what is the maximum price that we are ready to pay, and whatever the price which is given to us in the question is the price which is prevailing in the market. That is what we understand. Okay. Second part of the question. The question says that should he invest in the bond? That is a question. Now second part of the question can be done by three methods as what we have discussed. The first is the NPV method, second is the present value of the cash inflow method, and the third is return method. I go with the simple NPV method. Friends, NPV is calculated as present value of the cash inflow minus investment. If you purchase the security today, then in that case the present value of the cash inflow is 1023.26 minus what is the investment to be made? Investment to be made is 1025.86. So minus 1025.86. So the answer comes to 2 rupees 60 paise negative. We understand that as NPV is negative, we should not buy the security. If at all you want to give answer with the present value of the cash inflow method, then in that case we can give answer like this. You are ready to pay 1023 and you have to pay 1025. So why will you pay more? You will not pay more. So the security should not be purchased. So over here the decision is like this. Security should not be purchased, comma, as NPV is negative. That is the way we are required to write the answer. Please take down answer. Next question. Also calculate yield to maturity YTM of the bond. That is a question. Try to do answer on your own. Friends, we understand that there are two methods by which you can calculate the answer. One is IRR method, which is quite lengthy, and the second is the approximate return method. You can apply the approximate return method because over here we can see that the interest rate is annually same. So over here we'll make the calculation like this. Answer of the third question. Calculation of return. In bracket I am writing YTM. YTM stands for yield to maturity. YTM stands for yield to maturity. Yield stands for return. And the return that you are able to earn for holding the security till it matures. That is considered to be the yield to maturity. So it is calculated like this. Annual interest income plus redemption value minus purchase price divided by number of years, whole divided by redemption value plus purchase price divided by 2, multiplying with 100 for getting answer in percentage term. This is the way we are required to make the calculation of answer. So it is 1000 rupees into 15%. That is 150 rupees is the income. Redemption value is 1000 minus the purchase price is 1025.86. Dear students, we are required to take into account the price which is given to us in the question for the purpose of calculation of answer, that is 1025.86 divided by the number of years, that is 3, whole divided by average. So it is 1000 plus 1025.86 divided by 2. Into 100 for getting answer in percentage term. So 15% of 1000 comes to 150 minus, why? Because that is negative. So it comes to 25.86 divided by 3. That is 8 rupees 62 paise. Whole divided by average. That is 1000 plus 1025.86. Total of both of them divided by 2. So 1012.93. So it is 1012.93 into 100 for getting answer in percentage term. So 150 minus 8.62. So 141.38. Whole divided by 1012.93 into 100 for getting answer in percentage term. So the final answer comes to 13.96%. And almost everybody has given the answer of 13.96%. Dear students, we don't have to draw any conclusion over here. We don't have to take any decision over here. However, we can understand it very well. That's the return which we are getting is 13.96, which is comparatively less. How comparatively less? Considering that the security is AA rated, we require the return of at least 14%. We require 14 and we are getting 13.96. Means we are getting comparatively less return. And that is the reason we understand that the security is not worth purchasing. And this is the answer even that we have in the second part of the question. So second part of the question answer can be written in one of the three methods, and all the three methods that we have discussed coincidentally. If at all you do the IRR calculation, then in that case you will get more precise answer. This is what we understand.